Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Ford. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a covered call in Ford, which I'm highlighting inside the options playbook. Very simple trade. We just talked about in the small downturn that we had a little bit of a breakdown in the S&P 500 index. On a monthly basis, last week we looked at the fact that we did actually break through a trend line on a monthly basis in the NASDAQ. NASDAQ was a little bit more bearish overall than the auto companies. And we're kind of building this more as an EV trade, an electronic vehicle trade. And we've talked of back probably 6 or 7 months ago, we talked about how Ford was getting into the EV space. And then recently they've reconfirmed that. And not only did they confirm that they were going into the EV space, they put their money where their mouth was. So on a down day, we had the auto companies in general, GM and Ford, both doing fairly well. So we looked at a covered call in Ford, mainly because if you want to be a little bit longer term, that's fine. But you're a little bit scared, right? Because the markets were getting beat up, even though Ford was having an up day on Tuesday, while the market was having a down day. So how could we participate in the stock and use options to try to soften the blow if the worst case scenario happens and all of a sudden the entire marketplace starts tanking overall, which everybody's a little nervous about. We had the VIX trading around 22, 23. VIX has now came back in. It's now trading below 20 level, which overall is a good sign. We got through September. We're now in October, and usually another volatile month. But ideally, we'd like to see a little bit stronger market going into November. And the VIX is kind of saying that may happen. Now, as always on the Stock Play of the Day videos, nothing's meant to be a recommendation. But on our Friday show, we talk about alternative trades based off of what has happened on Tuesdays. It's a little short and a little sweet. We don't get a lot of activity in the marketplace, but it's just more about tossing ideas out that you can apply to your positions that you have stocks on. Okay, so on a covered call, it's quite simple. We wanted to buy Ford stock. So the concept was we're going to buy 100 shares of stock, but markets were a little so we went out and sold a call just to say, well, all right, we're going to give ourselves a small buffer just in case the stock Ford goes down with the market later on by the end of the month. Well, that didn't really happen. It kind of stayed a little bit flat overall. But by selling that call, we brought in some premium, and that premium lowered our cost basis on the stock. And so let's see what happened with Ford. Okay, so if I go to our charts inside the Ally Invest Live platform, we usually look at a 15-minute chart. And we always tape the Stock Play of the Day live on Tuesday. So it's at noon Eastern time. So I just draw a little ray across here from noon all the way to where we're at right now. So on noon, stock was right around here, which is, I think, 14. Well, it was around 14.16, somewhere in that range. Markets are moving, so I don't have the exact, at the moment that we decided to do the paper trade, the exact price, but we're approximately there. All day, trade a little flat, a little bit up, not just kind of some noise. On the downside, it looks like we're down about a quarter on it, so that was nothing to sneeze at, because that's about what we were bringing in on a $14 stock. That's a fairly decent amount. And then we had a good up day on Thursday, traded up all day. On Friday, right now, this is where we're at. We had a solid up day on the open, and we've given a little bit back. But bottom line is we're at 15.20 overall, which is just a good solid return in a few days on Ford. So now what is our issue? Well, we're almost to where our short strike was. As a matter of fact, it looks like it came up and I didn't even really notice this until just now, but our short strike is 1550. So we actually touched that short strike overall. We did a shorter term option contract. We didn't bring in a ton of premium, but you're not going to bring in a ton of premium on smaller price stocks. There's still volatility in the marketplace, and the vol was fairly high when we put that trade on overall. And we're going to show some positiveness because on this trade, we ideally on the short call, we were wrong in that the market has came up to that price already. We wanted it to come up a little closer to the expiration date, but volatilities were higher. I talked about the VIX being around 22, 23. And because of that, all stocks in the marketplace were a little bit higher. So let's see what happened with the trade overall. So if I run into the Ally and, actually, I want to talk about this chart. Let me do that. Okay, I'm glad I had this in here. We're going to go into the chart and we're going to actually look at the trade. But I just want to show you something with Ford. Now, people will call moving averages, they have a lot of people look at things that are called death crosses and that are called golden crosses. Now, I think they're much more important around a 200-day moving average, just kind of showing you momentum in the marketplace. Don't add a lot of value to it on a technical analysis basis. But I'm going to show you in Ford where there was a couple of these that happened that were interesting. And the reason why I bring that up is that this week we actually had that. The 50-day moving average is in red. The 20-day moving average is green. And you see that the 20-day moved up through the 50-day moving average. That would be considered a golden cross. Now, on the 20-day and the 50-day, it's going to happen a lot more than on the 200-day. Obviously, you're just looking at longer time frames overall. But we kind of see, if you look at Ford and if you just kind of follow some stocks, I think this is more pertinent. And I think that's true about all technical analysis stuff. But it's more so volume. I think the more volume, the more technical analysis is interested. And just in general, things that will trade a little, not as news based, that aren't as crazy with news headlines hitting you left and right, like pharmaceuticals, obviously. But if we look at this situation, we had a downturn. We had the death cross here, which I think, I just hate that term overall. But if you would have sold here and then waited for the upturn, hey, you would have did all right. You would have been buying right around this range right here, and you got a solid upturn in the marketplace. Also, the same thing back here. We had the 20-day move through the 50-day. You'd sell, you'd get out, you'd be getting back in right here. Down here, we didn't quite hit it, so it wasn't really a sell signal, which was probably a good thing. And then this is the one reason why I have this, is that I'm talking about when the cross happens on a 200-day moving average, it's a little bit more interesting. And this is obviously, there's a lot going on in the marketplace, and you're going to find instances where it just doesn't work. I mean, that's what technical analysis is all about. But ideally, a good solid market is when you have, if you're in a good solid uptrend, which we've been in the S&P 500 index for a long time, you like to have the 20-day above the 50-day above the 200-day. So all the way back in September, right here, that's what happened. We had both the 20-day and the 50-day break through on Ford. Now, it happened right there, and we still had some downside. But one of the things that was interesting about it is it just really didn't establish that downside below the 200-day. 200-day gave a lot of support. But if you were buying in this area, or in particular when this cross happened, obviously you had a really solid upturn in Ford overall. So you can probably go back and look at other situations where the turn right here, you would have got out on the downside. So you would have, it just meandered for a while. Once again, provided some support before we got the bad news overall. But this would have been a selling point for sure if you're following those type of rules. So I just find it interesting. Every once in a while, I just like to point out things that are interesting to me technically wise. I don't always and it depends the underlying that I look at. I do look at Ford in general, and these little death crosses and golden crosses seem to carry a little bit of weight. You obviously got to pay attention to what else is going on in the marketplace too. The news is a pretty big one. The fact that they're willing to put billions and billions of dollars into the EV space has made Ford a cool stock again. Relative, I guess. I don't know if that word cool means a lot in investing, but it seems to overall. So let's look at what we did. Okay, I digress. Ford, don't forget earnings are coming. We're getting into earnings season on the 27th. So because of that, we did the October 22nd covered call. We did not want to be in going into earnings, and I usually don't like to be in covered calls going into earnings, and I talked about that extensively. So the stock is up 27, but it's up quite a bit. It was at 416 when we looked to do this trade. Oh, and we sold the 1450s overall. So when we did this trade, it was at 416. So I wasn't 1550, it was 1450. And we actually broke through on that underlying. So now we're looking at 1550 is now in play. So our call option would get called away from us, or our stock would get called away from us. We'd have a solid gain in 1 week's time. You wouldn't sneeze at it overall. But what can we do to adjust this trade now? Now, in order to put an adjustment on, I'm going to highlight a section inside the options playbook called managing positions, how to roll a covered call. We've gone a little bit too far here. We're too far in the money already to consider rolling in the same time frame. And we also have earnings coming up next week. And this is what's interesting about today's stock play of the day, because a lot of times when we look at this, we were correct on our forecasts. We had a very solid trade going on. We have a gain in that position. One of the things you can just do is you can just buy and close it. If you've got that paper trade on and you just want to get out of the position, you just buy and close the short option. Just remain long the stock. And a lot of people have a problem with that, and I don't quite understand why. So it gave you the pillow, it gave you that small little pillow to land on. The marketplace was a little bit nervous overall. We're only going out till October 22nd. And we took our position because we could hedge a little bit by selling a call option. Now I've waited too long. When I got to 1450, I should have thought about just getting out. I didn't do anything. Close it, move on, stay long your stock. Quite simple. If you roll now, you're going to have to roll out in time, and you're going to get some premium because we're going to have to roll into the earnings report. So how would I look at it? I don't want to be in this in the earnings. And if we would have did it when the underlying stock was at 1450, which is mentioned in here, this is kind of what we're talking about. Just don't let it get too far in the money. Don't let it get away from you before you roll. If we would have done it at that time, we might have been able to roll up in the same expiration, just roll up and strike, maybe for a small debit or whatever. But we could have gone and just rolled up a little bit in strike and been okay with this. Now, if we want to, we're going to probably have to roll out in time. So let's look at the potential roll. Okay, we are short the 1450. And so that means we're going to be buying to close that option contract. And then I'm going to bring out the October and maybe even the November, because if we're going to ride this in through earnings, I might even go beyond and go out to November, just because why not? Because the earnings is what we were trying to avoid by doing the shorter term option anyways. And we weren't able to go up that high and strike because of it. Okay, so the 1550 is a 44-cent option contract. I'm going to have to pay a fairly decent debit in order to do that. That's 88 cents. If we go all the way out to November, yeah, we're still not getting a ton. So this just isn't that attractive to me to roll. And it's mainly because we missed the boat. We missed the opportunity when it was trading at 1450. Okay, so you close it out and you move on. Or one thing that we could do is we could just sell something going into earnings. So in this instance, I can't really roll up and get this done for a net credit to the account. Because if I'm selling the 15s, which is right about where that strike is at right now, I'm still paying a debit. So let me show you that. And even though we're going to be doing it going into earnings, it'd be a net debit of 15 cents to the account. You would be buying to close the 1450, selling to open the 1 week out further, the 29th, 15 strike call, net debit of 15 cents to the account. Not bad. You're giving yourself 50 cents worth of upside, but you're paying 15 cents and adding 15 cents of risk to do that. I would probably do this. If it really bothered me, and I'm going far here, right? I mean, we got a game, we got everything going on. I kind of mentioned that I would probably just buy and close it, but I would probably sell the actual same strike. And I'd say, well, going into earnings, if it takes off, that's fine, but I can get this done and I'll figure out what happens after earnings. So I sell the 1450, I buy this 1450 to close. I bring in a net credit of 16 cents. And I would be looking to roll that covered call. Now, remember, you have 100 shares of Ford, right? That's your main position here. The option is just it's taking away some of your opportunity on the upside. You still got upside on Ford, but you got limited and known only to that 1450 strike. So not a lot of people think about doing this overall, but if I put it in the right rail, I'm going to actually use the right way to enter the order. That means we're going to be buying to close that October 22nd, 1450 strike call, selling to open the 29th, 1450 strike call, doing it for a net credit of 16 cents to the account. Now, if I do this, I have earnings that are going to happen on the 27th. I run all the way up here. That's when it is, it looks like. On the 27th. Okay, so we have earnings on the 27th. If I go and I do this trade, I'm hoping that Ford will actually be below 1450 after earnings. So it will sell off a little bit after earnings. And I still own the stock. I would brought in a credit last week of around 30 cents, and I would bring in another credit this week of about 45 cents. Give me a small pillow to land on overall. But 45 cents on a $15 stock, that's a decent amount. Right now it's up 23 cents on the day, and that's 1.5%. So you can double that. You're looking at, let's say if it was 50 cents, you're looking at about a 3% amount that we're bringing in by selling the call and then rolling the call. All right. Well, that's it for this edition of options play of stock play of the day overtime. Sorry, I got a little bit long-winded. We don't talk about covered calls a lot. It's one of the most popular strategies within our Ally Invest client base. So I wanted to address this extensively, and it's part of the reason why we looked at a covered call in the first place. Thanks for coming, everyone. Click subscribe, ring the bell, and we'll see you this Tuesday for the next stock play of the day.